Oh, yeah, they transfer.
I like them to transmit your body temperature. Your body temperature. No, that's the thing.
You know what it does do? It measures your heart rate.
Oh, yeah.
And what happened is, for some reason, my heart rate jumped up. It was normal.
And they keep.
It alerted me.
Yeah, is that right?
All right. Ready to go. Well, welcome to the November issue of our Economics and Finance Speaker Series. Just one piece of business before I introduce the speaker is the next session. There'll be no session in December. The next session will be in mid-January with Jim Austin on leading economic indicators. So our speaker today, many of you, I know some are well acquainted, and maybe all of you, but Naram Baravish, is that close? Right. Is chief economist at the consulting firm IHS, and author of Spin-Free Economics, a no-nonsense, nonpartisan guide to today's global economic debates. Directing the entire economic forecasting process at IHS, he is responsible for developing the economic outlook and risk analysis for the United States, Europe, Japan, China, and other emerging markets. He oversees the work of over 400 professionals located in North America, Europe, Asia, Latin America, Middle East, and Asia to cover economic, financial, and political developments in over 200 countries. The subject today for us is, will the escalating trade conflict derail the Trump growth agenda? Here to enlighten us is your neighbor and ours, Marilyn Groves.
Thanks. Thanks for inviting me. Thank you for coming this afternoon. Just a little background about myself. My family and I have lived in Lexington since 1992. Our kids grew up here, went to school. I know some of you, Bob, I know, Walter, I know, a number of you, know well. So, we've had a wonderful time here, and we certainly plan to stay here for a while. I first started to work for a company called DRI, Data Resources Incorporated. They were up on Hartwell Avenue. And in fact, Walter and I worked there together for some years. We then were merged with a competitor company in 2001, became Global Insight, and then after that we were acquired by IHS. So just a little history about sort of what brought us here and what kept us here. The one thing that has changed is that when I worked on Hartwell Avenue, I had an enviable 6-minute commute. Now I work in Cambridge, and the commute is 45 minutes each way, which does not make me very happy. So basically, I spend at least 2 or 3 days working from home. Much more pleasant, wastes less time, obviously. So anyway, here we are. The title has to do with policy, whether or not the trade actions and the escalating trade war is going to derail the Trump growth agenda. And to an extent it already has. I'll give you some numbers in a few minutes. But yeah, there's a very high risk that if we keep going down this path, that we will definitely erode a lot of the boost to growth that we've had recently. So part of the theme I'm going to focus on is that we are getting a nice, because of the tax cuts, a nice boost to growth in the near term. That growth is going to fade by 2020, late next year, early 2020. And in the meantime, we are quite vulnerable, not just to the trade issues, but to other issues as well. But before we kind of get into what's going on now and where we're going to be going for the next couple of years, I'd like to step back a little bit and look at what has happened in the last 10 years. And if you remember, 10 years ago, what was a garden variety recession in the US and other parts of the world morphed into the worst economic downturn and financial crisis since the Great Depression. Now, there are some very similar things to what happened, not only in the Great Depression, but other financial crises. If you go back, various studies have been done looking at financial crisis over the last 800 years. And they share two things in common. And that is, number one, debt, and number two, banks. So banks and debt have played starring roles in financial crises, and they did 10 years ago. The big difference between 2008, 2009, and the prior crises, including the Great Depression, was the role played by the Federal Reserve and other central banks. They essentially pulled out all stops and did what they had to do, took very aggressive action, and basically prevented this thing from turning into Great Depression 2.0. Those of you remember, at the time, Ben Bernanke was chairman of the Federal Reserve. He's a very well-known professor, even before he became Fed chair at Princeton. And at a conference some years ago, in honor of Milton Friedman, who's quite a famous economist, Nobel Prize winner, Friedman and some of his colleagues have done a lot of work on the role of the Fed in worsening the Great Depression. In other words, again, the Fed made a number of mistakes and turned that downturn into something horrible. Bernanke, in speaking at this conference, and Milton Friedman, who had done this research, was sitting in the front row, and Bernanke said, this is before 2008, 2009, Bernanke said, the Fed blew it, we'll never make that mistake again. It's an interesting comment, and they didn't. They learned, and Bernanke he's a student of monetary history, and they learned their lesson. And they not only cut interest rates all the way down to zero, but they basically started to buy massive amounts of government securities and mortgage-backed securities. And that saved the day in the end. I mean, saved the day in the sense that it was bad enough, but it would have been far, far worse if they hadn't done that. Let me elaborate on these sort of three themes, and then I'll add a little bit of color as well. So debt, banks, and monetary policy. First of all, debt. As often happens in these crises, in the run-up to the crises, there's a lot of speculative activity. Tulip bubbles in the Netherlands, Louisiana land purchases, you name it. I mean, there's just a whole series of things. People speculate, basically. And that's what, in effect, happened in the US with housing. There were people who expected house prices to rise forever, and of course they didn't. They never do, but there was that expectation. People are caught up in the euphoria. And of course, there was a lot of lending going on, and a lot of very questionable lending going on. 100% mortgages, people qualifying who should have never qualified for a mortgage, given their income levels, all that kind of stuff. And then the banks got in on the act, and they developed all these very fancy instruments of packaging mortgages and so forth and so on. I won't get into all the technical details there. But the debt levels rose, and it was private sector debt. Usually it's private sector debt that gets us into trouble, and this was housing related. And it wasn't just the US, the UK was involved, Spain was involved, Ireland was involved. So it wasn't just the it's the US story. So private sector debt rose. After that, of course, it was a big drop in private sector debt. A lot of households cut back on their debt, either voluntarily or by force. There was a lot of foreclosures, if you remember, a lot of households being forced to essentially cut way back. And so the good news is household debt, as let's say a share of take-home pay, has gone way down in the last 10 years. That's really good news. So it means the households are right now in a much better financial position than they were 10 years ago. But of course, in the process, what happened was government debt rose very dramatically. And the reason that happened was twofold. First, in a recession, taxes, the amount of money the government collects drops because the economic activity drops, and therefore the taxes you can collect from people's incomes and so on drops. So that means that the deficit goes up, the budget deficit goes up. But the other thing, if you remember, that happened in early 2009, the Obama administration put in place fiscal stimulus in an attempt to kind of forestall this downturn. They didn't forestall it, but they made it less bad than it otherwise might have been. So that combination meant that debt rose very dramatically, government debt rose very dramatically, and has stayed high, by the way. Now, of course, what's happened recently is with the tax cuts and spending increases that were enacted earlier this year, debt is even rising further. So we now have a situation where we have basically budget deficits that are $1 trillion a year, $1 trillion a year as far as the eye can see. So that means our debt, our government debt, is going to keep rising and rising and rising for some time. That sort of creates a huge problem down the pike, not right away, but down the pike, which we can come back to later. So my basic message, private sector debt, not so much private sector debt alone, but household debt dropped, whereas government debt rose. So there was kind of a change in the mix of debt. It hasn't, total debt hasn't gone down, but the mix of debt has changed away from household debt in favor of government debt. The other thing that's happened, which is a bit of a concern, is that corporate debt in the last 10 years has risen. And the reason corporate debt has risen is interest rates are very low, as you know, still low, even though they've been rising, they're still low. And so corporations decided that this was a good time to load up on debt. And they used a lot of that debt to restructure their debt away from sort of high numbers, high rates they were paying earlier to lower rates. But the other thing they did quite dramatically was they used that debt to buy back their stock. So one of the reasons the stock market has done so well is because corporations took on a lot of debt and bought back a lot of their stock. So corporate debt is a problem. It has risen quite a bit, and it creates a vulnerability because as interest rates rise, and they will, that the burden of that debt is going to rise. It's pretty low right now because interest rates are low. But as interest rates go up, and they will, as I said, that creates a problem. All right, so that's the sort of very quick and dirty on the debt story. So quite a change in the composition of debt. Household debt down, government debt up, corporate debt up. What about banks? You know, what role did they play? As I said, they always played a bad role because they always end up with a lot of debt that forecloses basically. And they're stuck, and they need to be bailed out, they need to be helped. And in fact, they were this time around. If you remember very quickly, this was in the waning days of the Bush administration, the US government put together something called the TARP, the Troubled Asset Relief Program, in which they bailed out the banks. But they also did one other thing. They put in place very strict regulations. The name of the bill, some of you are familiar with, was Dodd-Frank. And again, it was an attempt to force banks to build what are often referred to as capital buffers, which is to basically keep more money inside the bank for a rainy day. I mean, that's the only way to sort of describe it in a simple way. And it succeeded. The capital buffers in the US banking system went from about 4% to 15% of their assets. That's big. So as a result, what's happened is banks have become safer, no question, but also they've become less profitable. So it's, I mean, there's always a trade-off. You're not going to get one thing without, having to give up something else, and that's exactly what happened. What's interesting now is that there are a lot of non-banks, I'm referring here to private equity and hedge funds, that have taken over a lot of bank activity, especially in the corporate sector. So a lot of the debt I was referring to on the part of corporations is being held by private equity, is being held by hedge funds and other sort of under-regulated non-bank financial institutions. That to me is a little risky because these institutions are more opaque now than the banks are. They're not as regulated, so it's harder to see where the problems are. And so that, I just kind of raised that as a yellow flag, not so much a red flag, just to say, this is something to keep an eye on down the pike. So that's the sort of the banking side of it. The monetary side of it, I've already sort of talked about a little bit, but let me just sort of elaborate a little bit. The Fed did do some very unorthodox things, which were highly controversial. I'm talking here about these asset purchases. The term used is quantitative easing. You know, that's neither here nor there in terms of a phrase. Basically, what it covers is massive purchases. And we're talking trillions of dollars here. Massive purchases of government securities, US Treasury bills, US Treasury bonds, and mortgage-backed securities. In the process of doing that, what the Fed did, and by the way, other central banks like the Bank of England, eventually European Central Bank, Bank of Canada, and so forth, jumped in and did exactly the same thing. But by buying all these securities, what the Fed did was pumped massive amounts of money into the US economy, about $3 trillion into the US economy over a course of about 3 or 4 years. That's huge, by anybody's standard, that's huge. Now, initially the worry was that this was going to translate into higher inflation. You know, a lot of money chasing around too much money chasing around too few goods. Didn't happen. Why? Well, a variety of reasons. One is that the recovery in the US was very sort of slow, and so there were no inflationary pressures to speak of. But very importantly, the question is, what did the banks do with that money? Did they lend it? No, they did not. They basically rebuilt their portfolios and their balance sheets. So a lot of that money got stuck in the banking system. But that's not a bad thing necessarily, because it meant that the banks were able to use this money to repair themselves, to heal themselves. As I said, they became safer in a sense. So no inflation yet. Even now, 10 years later, we don't have that much inflation. There's a little bit. And the banking system is safer. So that's why I view this experiment, even though it's very controversial. There are a lot of people who criticize it, still criticize it. But I view it as a success, because on balance, it really did help. And it prevented, as I said earlier, this downturn from becoming far worse and becoming sort of Great Depression 2.0. Instead, we just call it the Great Recession. I don't know why economists put great in front of bad things, but they do. So great, so anyway, now, good news is that other central banks followed suit. They followed the Fed's example and did essentially the same thing, and it helped across the world. Now here's the dilemma, and this is the reason I go back in history is because we're still living with the consequences of a lot of what we've done. And one of the big consequences now is, of course, that the Fed is trying to unwind all these bond purchases. It's reducing what's called its balance sheet. It's mostly it's doing it by not rolling over its bond purchases. In other words, as the bonds come due, it just lets them lapse. Or it's selling some off, but it's gradually bringing its bond holdings down, very gradually. It's gradually raising interest rates from 0. Now the interest rates are around 2.25. This is short-term. Interest rates are around 2.25. And so for the US, this is fine. We've got a lot of momentum in this economy, and so it's not doing a lot of damage at this point. However, it is doing damage outside the US. And I'm referring here specifically to emerging markets. So think about what happens when the US, which has very safe assets, and is considered a safe haven, as the US raises interest rates, the returns on safe assets go up, so this attracts a lot of money back into the US. And away from riskier places like emerging markets. So what we've seen in the last 2 years, since the Fed has started to raise interest rates, money coming out of the emerging markets into the US. That in turn has depressed the exchange rates in the emerging world. Basically, if money comes out of, say, Brazil, that puts downward pressure on their currency, because people are selling Brazilian assets, buying US assets. And so this downward pressure on the exchange rates in Argentina, in Turkey, in Brazil, you name it, is creating a lot of headaches for these economies and their central banks. This is something, and of course the fleeing of capital. As capital leaves, let's say Brazil, that's in effect a tightening of credit conditions. So one of the consequences, the point I'm raising this is one of the consequences and one of the fallouts from what has happened over the last 10 years is now, as we reverse things, then we're imposing costs and damage in other parts of the world. All right, let me just say a few other words on the sort of the aftermath of this pretty horrific event that we went through 10 years ago. Certainly growth and the recovery period after a bad financial crisis as we had is long. So the typical recovery period, the typical period in which the economy gets back to where it was before, basically, is at least 7 or 8 years. It took us about that long. So this was not unusual. But of course, in the process, growth is weak, employment growth is weak, it takes a while for the unemployment rate to get down, and as a consequence, of course, there's a lot of great unhappiness, and I'll say a little bit more about that and the political fallout from it. So the good news for the US is we actually came out a little bit faster than everybody else. There's some countries like Italy are still not there. Their GDP is still below where it was before the crisis. So in that sense, we've done better than most. Not everybody. Germany, I think, has done a little better than us, but better than most. One area that has done incredibly well, and as some of you may be well aware of this, is the stock market. You know, I asked the question, what happened to all that money that the Fed pumped into the system? Some of it ended up in the stock market, or a fair chunk of it did. So the stock market, I mean, the S&P 500 before this latest sort of sell-off was still about sort of 3 times higher than where it was in the beginning of 2009. So stock markets did incredibly well during this period. A lot of that having to do with all this money, all this sort of cash, basically, all this liquidity sloshing around that the Fed had kind of pumped into the system. So banks benefited, stock market benefited, other asset markets did as well. Now somebody will ask me, is the market overvalued? That's always the tricky question. It's almost like an emotional question. Is the market overvalued? I think most measures of valuation would suggest that the market's rich, but it's not overvalued, it's not in bubble territory. But that doesn't mean much. We could see an even bigger correction than we have seen recently. Although I rather doubt it. I don't think we're certainly not going to see the gains that we've seen in the last couple of years. But I doubt that we're looking at the beginnings of a bear market at this point. But we can get into more. I'm not going to say more about the stock market now, but we can get into it later if you want. So stock market did well, the economy did so-so. And that in and of itself, plus the fact that inequality widened in the last 10 years. It was already widening before this, but it widened. Before the Great Recession, the widening or the worsening of inequality had to do with the twin forces of globalization and technology. Technology being a much more powerful force, by the way, than globalization. Globalization gets all the blame, but technology is a far more powerful force in terms of inequality, in terms of job destruction and so forth than globalization. So that was already going on, and then you get this horrible recession which raises the unemployment rate. And so inequality worsened even more in the last decade. And that gave rise, not just in the US, but elsewhere, to populism. So we've had economic fallout, we've had political fallout. And so certainly things like Brexit in 2016, and then the Trump victory in also 2016, to me were manifestations of the anger and the backlash from all of this. Again, the earlier stuff with globalization and trade, and then, of course, the recession. There's a whole group of the population that I call the left behinds, people who feel left behind and feel basically shafted by all the stuff that's been going on. And some of the rise in populism, in my mind, is that backlash that's going on right now. And so that's, we're living with the consequences of this, and we'll continue to live with the consequences as we go forward. All right, one more topic in terms of this retrospective, then we'll talk about the outlook. And on the outlook, I'm just going to mostly focus on the US, a little bit on China, but if you have questions about other countries, I'm happy to answer. China is an interesting case in study because once the Chinese government saw what was going on in the US, Europe, elsewhere, they too got scared. And they too pulled out the stops, basically, and pumped up their economy through both fiscal stimulus, government spending, and monetary stimulus. And the way they did the monetary stimulus was interesting. It's very different than the way the Fed did it. They essentially strong-armed their banks, which are basically state-owned banks, to making massive loans to the corporate sector. So if you look at the impact of that, initially it was great. China's growth continued despite what was going on in the rest of the world. But the consequence was the Chinese debt exploded. China's debt went from about 120% of GDP, economists always look at ratios, to about 260% over a 10-year period. Now, that may not sound like a lot, but it's massive, especially for an economy the size of China's. And some of you have heard me say this before, but it's worth repeating. No country has ever gone through that kind of a massive debt explosion without something bad happening. The question is, what is that something bad? And it takes two forms. One is what we went through in 2008, 2009, a meltdown, basically. That's not going to happen in China. As I mentioned, their banks are state-owned, state-run, state-supported for all intents and purposes. And so they'll bail them out very quickly. They won't let this happen. They'll force them to keep lending and not cut back. The other scenario, the second scenario, is what I call the Japanese scenario. And Japan went through a similar thing in the early 90s, and it had 2 decades, basically, of growth of 1% a year, average growth of 1% a year. So the worry is that China's going to be looking at a lost decade or 2, possibly. Now, what is a lost decade or 2 for China mean? It means growth of 3 or 4%. Now, most countries would love to have 3 or 4% growth. But China needs to grow at least 5% to absorb all those workers that are coming in from the rural areas into the cities. So 3 or 4% growth for China, in effect, is a recession, although it's a positive growth. So the worry, the risk scenario, if you want to say it that way, for China is indeed that. Now, a couple things, just to kind of add a little bit of color on this. What was all that debt in China used for? You're familiar with some of it. Some of it was real estate speculation. There are roughly 50 million apartments that are empty right now in China, 50 million. That's not quite, but almost a quarter of their housing stock. In the US, it's more like 10% that sits empty. And we're talking here about vacation homes as well, don't get me wrong. I mean, many of us have vacation homes in Maine or wherever we have them, and they sit empty. Okay, fine. But here we're talking about people who bought homes in China and apartments to speculate. Basically, again, in the expectations, as I said earlier, of prices rising forever. And of course they don't. The second thing the Chinese used this money for was to build massive amounts of excess industrial capacity in industries like steel, like chemicals, automotive, iron ore, massive capacity utilization in many of these industries is 60%. Now the usual capacity utilization we think of as being okay is 80 to 85%. 60% is very low. But just to kind of put a little bit of context here, let's look at the steel industry, which Coach Walters favorites. He's one of the experts. He may correct me if I'm wrong here. But the excess capacity in the Chinese steel industry is equal to the total capacity in the US, Germany, and Korea combined. Just think about that for a minute. The excess capacity in China's steel industry is equal to the total capacity of these big steel producing countries. That's scary. So how does this resolve itself? Now, this again is a legacy of what China did in response to the, the crisis of 2008, 2009. How does this resolve itself? Well, in a capitalist system, it's tough love, basically. You go through consolidations, you go through all kinds of bankruptcies, output goes down, employment goes down. Chinese don't want to do that because they're very worried about social cohesion and social unrest. So what they've done is that they keep delaying it and delaying it and delaying it. They go through these episodes where they try to deleverage or force deleveraging, but then the moment that results in a lot of unemployment, they back off. So there's a sort of stop-go policy that they've been involved in the last, say, 2, 3, 4 years. And they're in the middle of one of the go phases in the sense that they've backed off. They're very worried right now, partly because of the trade war, but they've got their foot back on the accelerator, gently on the accelerator, but nevertheless on the accelerator. So China's living, again, with some of the fallout from what's happened. All right. So let me give you a little, now we'll look at the future, basically. We've been looking at the past mostly, although the past obviously has huge implications for the future, as I've hopefully tried to show you. But let's look specifically at the outlook for the next 2 to 3 years. I mean, good news is global growth is decent. It's about 3% right now, which historically is not great, but it's not bad either. But the mix is quite interesting because the US is accelerating because of the tax cuts and the spending increases, whereas just about everybody else is decelerating. So I'll give more detail on the US in a second, but let's look at the countries that are decelerating. So Europe is decelerating, and a fair chunk of that has to do with political uncertainty. European businesses and companies are very worried about three sources of risk. First is Brexit, and it's been in the news recently, as you know, today, two, maybe more, of the ministers of the Louisa May. I'm sorry? Resigned, yes. In protest of this negotiated Brexit agreement. What happens next is hard to tell, but it's going to be tough. It's not going to be easy, and I think there are going to be a lot of bumps along the road here. So Brexit is one of them. And it's not just hurting confidence in the UK, it's hurting confidence in Europe as well. Because a lot of European companies do business in the UK, and they don't quite know the basis under which they're going to be doing business. The second one is Italy. Italy is at loggerheads with the European Union over its budget deficit, which is supposed to be 0.8% of GDP, but Italy has come up with a budget deficit that's 2.4% of GDP. So this is again one of these sort of existential threats now, again of the euro. Greece they dealt with Greece, but Greece was tiny. Greece is 2% of the Eurozone economy. Italy is almost 15% of the Eurozone economy. They can't ignore Italy. Now, Italy is not going to go away. It's not going to leave, although there's all these jokes about quit Italy, but okay, fine. No, Italy's not going to leave, and they're not going to let Italy leave. I mean, it's a political decision as much as anything. Because if Italy leaves, it's all over. That's not going to happen. But still, markets are very worried. And businesses are very worried. And banks are very worried, because a lot of this huge bank exposure in Italy. Not just Italian banks, but German banks and French banks. And then the third worry is, of course, the fact that the German coalition right now is very wobbly. Chancellor Merkel has lost a lot of support, a lot of that around the whole immigration thing that has sort of come back to haunt Germany and other countries in Europe. So you got these three major economies with huge political uncertainty, and I think that's hurting Europe. China we've talked about, but China's growth is slowing. Just to kind of put things in perspective. Last year Europe grew 2.5%. This year Europe's going to maybe 2%. Next year 1.5%. So definitely decelerating. China very similar. Last year they grew 6.9. This year 6.5. Next year about 6. So China as well is slowing. Now the US, as I said, is bucking this trend to some extent, and it's mostly because of the fiscal stimulus, tax cuts and spending increases. So last year we grew 2.2 in the US. This year we think 2.9. Next year we'll hold up at about 2.7, but by 2020, the stimulus wears off. Basically, the tax cuts have a limited duration. Now, everybody wants, not everybody, the Republicans would like to extend them, the Democrats don't want to extend them. So it looks like they're the tax cuts will wear off, the spending will as well. So by 2020, our growth rate's down to 2%. So 2.2 last year, 2.9 this year, 2.7 next year, 2.0 in 2020. So that gives you some sense of sort of where we are in the global context. So we have been accelerating, we'll eventually decelerate, but everybody else is already decelerating. It's a very sort of a mixed bag. Before I sort of dig a little deeper and unpack the US story, let me just give you a little more context about the global economy. We'll talk about two or three things very quickly. First, oil prices. I don't know how many of you follow oil prices, but just a few weeks ago, oil was up almost, it touched 90 a barrel. I'm talking here Brent price. For those of you who follow, the two prices that we follow. One is Brent, which is the global price, and the other is WTI, West Texas Intermediate, which is more of a US, and that's about $10 lower. So, I'll talk about Brent, okay, the global price. So, it touched 90. Recently, 2 days ago, it was down around 65, so it's done this, okay? Oil markets are gripped by what's referred to as a competition of fears. On the one hand, fears about growth. So if you believe, and as the markets believe, the slowing growth story that I've been telling outside the US, they're more worried about that than worries about supply disruptions having to do with the collapse in Venezuelan oil production and of course now the Iran sanctions. So both of those will take some oil off the, have already to some extent, will continue to take oil off the market. The offset here though is, again, for those of you who follow, has to do with US production, which is rising and rising very rapidly out of the most prolific part of it. There are many basins in the US, but the most prolific is something called the Permian Basin in Texas. The issue right now is pipelines. The reason we're not getting even more oil out into the US has to do with pipelines. Now they're building them like crazy, and we figure by the middle of next year we'll start to see more pipelines and more oil flowing. The very good news, of course, for the US is that we now are a major oil producer in the world economy. Some people have suggested by 2025 we'll become the biggest oil producer in the global economy. I'm not enough of an expert to really pass judgment on that, but it's possible. So from that perspective, this is a good situation. Now in the meantime, we're going to see a lot of volatility, as we saw very recently. Now, that's crazy. To have those kinds of swings, $20 drop in oil prices is massive, by anybody's sort of definition. So oil, probably not hurting, maybe helping a little bit, it's hard to say. Now, just one thing, the US as a producer, it used to be an oil price increase was bad news for the US. Not anymore. Because an oil price increase means increased production in places like Texas, North Dakota, and so on. So any negatives from an oil price increase are actually offset by positives. All right, so oil prices. Two other things I want to spend a little bit of time on. We talked about the Fed. What's the Fed going to do going forward? I mentioned earlier that interest rates are going to go up. They are going to go up. The Fed's already raised rates quite a bit in the last 2 years, and we see the Fed continuing to raise rates in the next 2 years. So 3 hikes one more hike in December of this year, 3 hikes next year, and one more, at least one more in 2020. A lot depends, of course, on what happens to inflation, what happens to the economy. So Fed raising rates, it's raised rates more than and earlier than other central banks. And that has implications for the US dollar. So we're growing faster than everybody else. Our interest rates are rising more and earlier than everybody else. So what does this mean for the dollar? it means that our assets are more attractive globally than other assets, say German assets or Italian assets, or you name it. And so that puts upward pressure on the dollar. So if people like our assets, they want to buy our assets, they want to buy dollars to buy our assets, that means the price of the dollar relative to other currencies goes up. And so the dollar will strengthen some more, we think, in the coming year. Now, I'm going to end, not now, but at the very end, I'm going to come back to what I think is the big issue facing the US, and that has to do with policy mistakes. But before I do that, I promised I would unpack the US outlook just a little bit, just to give you a sense of why do we say the US will continue to do well this year and next year. And then I do want to talk a little bit about what we expect from the outcome in terms of the economy will be of the midterm elections, and then we'll talk about policy and policy mistakes. So I mentioned the US growth numbers, but let's just kind of look at the components of it. On the backdrop of this strong growth I mentioned at the very outset, it's temporary, and it pretty much all has to do with fiscal stimulus. Huge tax cuts, huge spending increases, which, as I said, push the US budget deficit up to about $1 trillion a year, and we'll keep it there for a long time. Those are big, big numbers. I mean, just, we sort of, our eyes glaze over when we talk about $1 trillion here, $1 trillion there, what does it matter? Well, it does matter. These are big numbers. Okay. And it's very unusual, I have to say this, very unusual to provide this kind of fiscal stimulus at a time when the economy is essentially at full employment. Very unusual. Happened once before in the late 60s. We had the Great Society and the Vietnam War, and during that period, we blew the top off the budget. Now, we started at a low number and eventually sort of got it back down somewhat. But now we started with very high numbers, and we're going to be even higher. Okay, but so we've been here before to some extent. We've learned maybe we learned a few lessons. I don't know. But anyway, the point is that it's just going to keep going. But so what does this mean for the various sections of the economy? For those of you who studied economics, I'm going to go through the key sectors of the economy: consumer spending, investment spending, government. We've already talked about to some extent, and exports minus imports. So those of you who remember your economics 101 is GDP equals C plus I plus G, X minus M. Okay. So just if you didn't take economics, don't worry about it. But let's look at each of these sections. Consumers in great shape. Okay. I mean, let's just look at the various parts of various influences on consumer spending. Jobs growth, very good. You've got an unemployment rate down. It's almost at a 50-year low. Income growth, good. Wages are beginning to increase at about a 3% rate a year. Interest rates, even though they've risen, are still relatively low by historical standards. If you look at, let's say, even the mortgage rate now, it's risen, no question, but it's still below where it was 10 years ago, or right before the recession, I should say. And of course, you've got the tax cuts. And consumers have saved some of the tax cuts, but they've also spent a fair amount of them. So consumers in pretty good shape. And if you look at surveys of consumer sentiment and consumer confidence, they're very high right now. Consumers are feeling really good, understandably. I mean, there's no reason for them not to. So consumer is probably the driving force here. They're about consumer spending is about 70% of GDP. So you want consumers to do well, and they are. The second part of GDP is investment spending, capital spending. And by investment, I'm talking about investment in physical capital of all kinds, equipment, structures, software, hardware, that kind of stuff. So here the corporate tax cuts did provide a boost, but it was a temporary boost. So what happened in particular was, for those of you who don't follow this, our corporate tax rates, the statutory rate, was at the top of the list, the highest, one of the highest among the industrial countries, among the what's called the OECD countries. Now we're somewhere in the middle. So it has provided a competitive boost, to a lot of US businesses. And for a while, not forever, but for a little while, they used some of that money to spend more on equipment, on buildings and so on. But it turned out to be temporary. Why? Well, I mean, some of it had to do with this debt burden I referred to earlier. Some of it had to do with the fact that interest rates are rising and that debt burden is going to be going up. And some of it has to do, I would say a lot of it right now, has to do with the trade uncertainty. A lot of companies are struggling with what's going on. First we started with steel and aluminum tariffs, which have ripple effects in a lot of industries that use steel and aluminum, so their costs have gone up. Then for a while we flirted with tariffs on European goods. We seem to have backed off that, at least temporarily. We flirted with the idea of walking away from NAFTA, but we managed to work out some kind of a NAFTA sort of light agreement, I'll call it that. And then of course now China. And I'll say a little bit more about the impact of the China tariffs in a minute, but the point here is that the uncertainty about trade, the uncertainty about tariffs is really hurting business confidence when it comes to the economy. If you look at the various business surveys, and there are lots out there, my company, IHS Markit, puts out one of them. We can see a lot of the details. Companies are really, really worried about this, understandably. It's creating untold uncertainty at a time when we really don't need it. Housing, bit of a weak spot because of two things. One, interest rates rising, mortgage rates have begun to rise. So housing affordability is less than it was, let's say, a couple of years ago. But the other biggie for housing is student debt. Student debt levels, of course, are quite high, but they affect that demographic that you typically would be buying homes at this age. And so student debt is not it's not like housing debt. It's not anywhere near as big as housing debt. But it is affecting that group of people who typically would be buying homes. And given their debt burdens, they're holding off buying a home. And we've seen that again and again and again. So that's a bit of a worry. So there's a sort of a weak spot there. Let's spend a couple minutes on trade, and I'll come back to it in the context of policies. But our imports in the US are growing faster than our exports. That's not a bad thing. It's not a sign of weakness. It's actually a sign of strength. Let me see if I can justify that statement to you. If we're growing faster than the Europeans and the Japanese, you would expect our imports from them to grow faster than their imports from us, or our exports to them. Is that a bad thing? No, absolutely not. It's a sign of relative growth rates and strength in the US. So we're growing faster than they are. And so it's not surprising that our trade deficit goes up. Our imports grow faster than our exports. So in that sense, this is not a problem. I don't see it as a problem. Now here's the irony. The Trump administration wants to take the deficit way down by the end of its 4 years, or 8 years, or whatever. Okay. But they pumped a lot of money into the economy through the tax cuts. That boosted GDP growth. So it means the deficit's actually going to go up rather than down in the next 2 years. You know what's the best way of getting the deficit down in the US, trade deficit? Push the economy into a recession. No, seriously, think about it. It means our imports just drop, right? I don't think that's what the administration is suggesting. But it's ironic, and there's a lot of these inconsistencies. You know, they want one thing on the one hand, and they do another thing on the other hand, and they're contradictory. And this is a perfect example. There are others. So, you know, from that perspective, trade is a drag. You can say it's a drag on the economy, but a drag for good reasons. Because, you know, the domestic economy is growing faster than the economies in other parts of the world. Just a few words about sort of long-term growth in the US. The long-term growth in the US is really a function of two things: our population growth, or labor force growth, and productivity growth. That's what determines the long-term trend of the US over a 10, 20-year period. Now, our labor force growth has slowed quite considerably for a variety of reasons, but birth rates is one of them. Our birth rates have been dropping. They've been dropping elsewhere as well, where it's not unique to the US. So our labor force growth has slowed and will continue to slow in the coming years. Now again, well, the other factor is productivity growth. But let me address, so combination of labor force growth and productivity growth determines long-term trend. Right now what we're saying is, based on current trends, long-term growth in the US is 2%. So this year, next year, we're going to be above that, which is not bad necessarily. Okay, so what do we do about these two? Well, how do we boost labor force growth in the US? One word: immigration. Okay? Again, we're doing the opposite. We want growth, but we're limiting immigration. Again, it makes no sense as far as I'm concerned. The other is productivity growth. And here I think there is room for a little more optimism, in the sense that we've got this sort of explosion of new technologies. And I think what we need to do is, through the tax code, through other incentives, encourage businesses to invest in the new technologies. So, from that perspective, the hope was, at least these corporate tax cuts would help that. I don't think they were structured quite right in the sense of encouraging that. Nevertheless, I think there are ways of doing it, and I'm more optimistic than perhaps most that we would probably see some improvement in productivity growth. Now, I'll get asked this question, and let me address it right now, about the impact of new technologies. The worry, of course, of a lot of people is that robotics, AI, you name it, is going to hurt employment more than it's going to help employment. You destroy a lot of jobs. Where are the new jobs going to be? Well, this is like the fourth industrial revolution that we're in right now. In every single one before, in the end, we've created more jobs than we've destroyed. I mean, that's just the nature of technology. The problem is, we know exactly where the jobs are going to be destroyed. We have no clue as to where the new jobs are going to come from. No clue. They will come, though. So, I mean, for example, we'll talk about the last one. How many telephone operators do you know these days? Right? Gone. But how many people do you know who, one way or another, are involved in developing apps? Well, quite a few, right, in the end. So, certain kind of job gone, others being created. We have no clue as to where the jobs are going to come. But I can tell you this, based on history, I'm very confident we'll, in the end, create more jobs than we'll destroy. It's a longer conversation we can have. All right, let me just say a few words about the midterms, and then I'll talk about policy risks, and then I'll open it up to questions. So, what can we expect in the next 2 years? I'm not going to make political forecasts. I'm not going to try to sort of figure out what's going to happen in 2020. But I think we can, based on what we've heard, what we've seen, we can make a number of guesses as to what's going to happen in terms of policy. I think certainly it's a safe bet that Mr. Trump will probably do more in the way of executive actions on things like regulation, on trade, immigration, foreign policy. So we're likely to see, he's going to be, I think, very frustrated by Congress, and by a split Congress, so he's going to take a fair amount of executive actions. Whether or not they can be blocked is a different story. Some of them will be, some of them won't be. Because of the split in Congress, certain things are completely off the table. Making the 2017 taxes permanent, tax cuts permanent, off the table. The Democratic House is not interested in that. In fact, now they're talking about raising corporate tax rates. I don't think it's going to happen, not in this Congress, but they're talking about it. Elimination of Obamacare, forget it. It's not going to happen. Now, it's changed a lot in the last 2 years, no question. But it still is around, maybe not be thriving, but it's kind of stabilizing is the way to say it. And then border wall funding, forget it. But that's not big. I mean, in the whole scheme of things, that is not a big thing. It's a political ploy, but it's not a big thing. I think there's certainly areas where we might see some bipartisanship. So, for example, I think both parties, or at least moderates in both parties, are interested in immigration reform of one kind or another. We might see something along those lines. And both parties and the president seem very interested in infrastructure spending. So we might see some stuff on that. I think those are areas that I think could see some action. And then question marks over trade policy and NAFTA. A number of the incoming senior members of the Democratic House have concerns about the new NAFTA agreement. So we may have to tweak it some. I don't think it's in danger, but it may have to be tweaked somewhat. Big question in my mind is, does the US go back in some sense to the Trans-Pacific Partnership? The TPP was called. You remember one of the first things that Mr. Trump did was he walked away from that agreement. This was an agreement of 12 nations in the Pacific Rim to get together and to do a lot of good stuff. The irony is the new NAFTA agreement basically mimics TPP. Even though we walked away from it, it actually mimics it. The other thing to be said about TPP is that it could have, and may yet still, become a potent instrument in terms of bringing China to task. Now, let me just elaborate on that for a minute. No debate about the fact that China is an unfair trader. China's mercantilist, okay, no question. China has taken unfair advantage of global rules. It has done stuff that most other countries haven't done and wouldn't get away with, but China has. So China needs to be, be brought to task, as it were. It needs to change its ways. I mean, it's the only way to say it. So how do you do that? You don't do it by going head to head with China. It's not going to work. I mean, you might get some concessions. I mean, there's something in the headline today about the Chinese may make some concessions. That's not the way it's going to work. The way we should do it is get our allies together and collectively put pressure on China. China will respond to that. If we're looking at 12 countries, Asian countries, European countries, so get together. Instead of which, what have we done? We fritter away a lot of our goodwill by going after the Europeans, going after the Canadians, the Mexicans. I mean, since when is Canadian steel a national security threat to the US? Okay, since when is a BMW a national security threat to the US? This is nonsense. I mean, it really is nonsense. So the point is on the trade front, I think, I'm hoping that we'll go back to TPP. Let me just say a few other words about trade and then just try to wrap things up, because I do want to leave some time for questions. On the trade front, the impact so far of the tariffs on China are fairly small. So you're looking at tariffs of 10% on $250 billion a year. In the end, that's not a big number. Maybe a tenth or two on growth for the US. But if indeed we do what the Trump people are threatening to do, which is raise tariffs to 25% on all of China's imports, that's about $450 billion, that could reduce US growth next year by 0.5 percentage point. So instead of 2.7% growth, we would get 2.2% growth. That's big. That's not an insignificant number. That would essentially erode all the positive growth aspects of the personal tax cuts that were put in place earlier this year. So you're back to, again, on the one hand they give, on the other hand they take away. Cut taxes, raise taxes. It's like, what are you trying to do here? So, just to kind of wrap things up, to me, policies, bad policies, policy mistakes are the biggest threat to US growth right now. And high among those are, of course, these tariffs and the protectionist measures that this administration has been flirting with and implementing now for some time. I would list a few other risks out there. What am I worried about? What keeps me up at night in terms of what could hurt this nice picture that we've got this year and next year? I referred to corporate debt rising and how that creates a problem for companies as interest rates rise. That's something I worry a little bit about. I worry about China's financial stress. Again, those very high debt levels I referred to before. And then I would say last, but Europe as well. I think, is there a chance that Europe could implode? I would say there's about a 10-15% chance Europe could implode, but I worry a little bit about that. I mean, they just seem to be lurching from crisis to crisis to crisis, so it's something to worry a little bit about. But where I sort of, again, coming back to policy in the US, I would say, here's the dilemma, especially on fiscal policy. We have used in the past, fiscal policy as a way to cushion recessions. So now we have these huge deficits, huge debt. What happens in the next recession? Where are the tools to be able to offset the recession when you already have all the stimulus, when you already have these gigantic budget deficits? So that inflexibility or lack of room to maneuver in terms of policy is one of the things I worry about. Not so much this year or next year, but the next recession. So I'll leave you with this thought. Come next July, this will be the longest expansion in recorded history for the US. Now, recorded history only for these kinds of things only goes back to the 1850s. Before that, we didn't have any really good data. But it will be, since 1850, the longest expansion. It will be in July of next year in recorded history. And I think we'll make it to that. I'm not really that worried between that and that. But the reality is, the probability of a recession in the US in the next few years rises. So that by 2020, now it's maybe 1 in 4. By 2020, it's about 1 in 3. And once we get past that, it's probably a little higher. And some of that has to do with the fact that that fiscal stimulus, I keep telling you, is going to go away. The Fed is going to raise rates. Who knows what's going to happen in terms of tariffs. And all of that creates a big vulnerability for the US economy. So 2020, we, my company, sometimes refer to a triple policy shock that the US could get hit with. Tighter monetary policy, tighter fiscal policy, and damage from trade policy. So on that down note, I'm going to stop. I normally don't. Walter knows this about me. I'm usually Mr. Sunshine, but I am worried these days. So let me just stop there. Happy to take questions at this point. Yes?
So you,
Yeah, and then I'll come to you.
you talked about being maybe common ground for infrastructure spending, but where's the money to do that going to come from?
That's a good question. There isn't a lot, especially in the current environment. So there'll be some. I think there's a lot of wishful thinking about, public-private partnerships and that kind of stuff. And I think there is a role for the private sector to play, in terms of infrastructure. I mean, I look at airports. I think, airports are a great source of revenue. And in some places they're privatizing, parts of them are privatized. I think there's a lot of scope to do more of that. So I think if they're creative, if they think, in the right way, I think, but you're right, public money, there's not going to be that much. Let's be honest, okay? That's not. Yeah, I'll come to you in a second.
You stated that the tax cut basically was a stimulus to the economy, okay? My understanding that tax cut given to corporations, they took that money and bought back shares. They didn't pump it in to create jobs or new technology. You want to comment?
I essentially said as much. I said, there was a little bump in capital spending, but then it wore off. So I agree with you. And they have used a fair chunk of that money to buy back shares. They've used money to kind of buffer various funds. So yeah, it's a problem. I think the big stimulus came from the personal tax cuts. Well, there's some from the.
I understand the tax cut for the person was mainly,
It was.
5-10% of the wealthiest people, not the common people.
Yeah, but the reality is, what I'm reflecting here, you're right. I don't disagree with you. The point is, we've seen a bump up in capital spending. It was temporary, along the lines you're saying, but we've also seen a bump up in consumer spending. So it is showing up, in terms of consumer spending patterns. But you're absolutely right, a lot of it was geared at higher incomes, so no debate about that. It was not the way I would have structured a tax cut. I mean, I don't know that we needed a tax cut at this point in our cycle, but it's certainly not the way I would have structured it. I would have structured it in a lot of different ways. I would have given the corporations a tax cut, but I would have done it in a way that incentivized them to spend on technologies, for example. I think that's what I would have structured, yeah.
Okay, one other thing to comment about the tax cut of corporations coming down, okay?
Yes.
But my understanding, before it came down, the average tax rate was 15%. That corporation would bring, not the 25% that you hear publicized.
Yeah. Okay. Again, a complicated story. No, it's a good comment. You're talking about statutory rates and effective tax rates. The statutory rates were what I said. The effective rates were lower. However, if you again parse it out and look at various companies, there were some companies paid 0 corporate taxes because they took advantage of all the loopholes, and there are other companies that paid full bore. So it was unfair in a sense. The old tax structure was unfair because it allowed a lot of people who had huge corporate tax staffs to game the system. So I think lowering the rate reduced the incentive to game the system, and I think became fairer because it gave everybody a break. So I think there was an advantage in doing that. It wasn't just the fact that, okay, so the effective rate was 15 now, or the statutory is 15, so what? It's a little more complicated. Yeah, yes.
So
Paul.
productivity is fundamentally important to improvement
Yeah.
of standard of living, right? How do you think about the relationship now between government debt crowding out investment that would otherwise improve productivity? Is this as dramatic a problem as I tend to think it is? I mean, we're now at what, 100% of debt to GDP?
It's
headed-
close, yeah, close to
headed
that.
higher?
No, I think you're right to be concerned about it. I mean, good news is, bad news, however you want to say it is, right now it's not an effective constraint because interest rates are low. I mean, the crowding out that you're referring to usually means that government borrowing pushes interest rates way up, and therefore it means it becomes more expensive for companies to borrow for capital spending. That's really not the case right now. It could very easily become the case a year, 2 years, 3 years from now. So it is a potential problem. It is something we need to worry about. So I think, yes, I would say, yes, it's a problem, but it's a problem down the pike rather than now. Okay.
And then this issue of total liabilities, when you start talking about, Medicare and
Oh, yeah.
Medicaid
Oh,
and
yeah.
pension debts.
Well, I mean, I think the reality is this, and I think I'm glad you raised it because I didn't touch on it. The deficit is exploding, interest costs on the deficit exploding. I don't know how many of you know this. Our interest payments on the debt are now more than our defense budget.
You kidding?
No, I'm not. You can go
You're
look
about
it up.
$600 billion.
Yeah. Oh yeah. Oh yeah.
Defense budget.
When you've got a huge deficit and debt like we do, that's the consequence. So, and it's going to grow. It's going to grow faster than the defense budget because interest rates are going up. So I'm sorry. What was the? You talking about
Medicare,
sorry,
Medicaid,
Medicare.
entitlement.
Yeah. Sorry, I lost my train of thinking in a second there. So how do we deal with this? And we're going to have to deal with it. Problem is, no politician wants to touch the deficit these days. It used to be, and I don't mean to pick on the Republicans but they used to be the party of fiscal discipline some years ago. Not anymore. Neither the Democrats nor the Republicans have any interest in tackling the deficit at this point. Any interest. So when is that going to change? Well, it's probably going to change when there's a crisis. I mean, sort of along the lines that you're saying. Interest rates spike, it creates a problem for the private economy. That could be another decade or two. What would I like to see them do? I would like to see them do entitlement reform. Now, nobody likes the notion of entitlement, because what does entitlement reform really mean? 3 things. You delay the retirement even more, okay. You lower benefits, you raise taxes. Nobody wants that. It's understandable. But at some point, we gotta do it.
Right.
And I think that's crucial. But again, at this point, there's no political appetite. They're not gonna touch that, which is a shame. Yes, I'm sorry.
When you talked about income inequality, you talked in structural terms, but you didn't talk in policy terms. I mean, in actual fact, more money has been going to the upper fraction of a percent,
Yeah.
not the upper 10%, as is
Yeah.
often said.
Yeah.
And tax policies have been exacerbating that.
Yeah.
I mean, what effect is policy having? And let me add into that, since consumption is so important in this country, and people are not able to consume large numbers of them, wouldn't that kind of reform actually be stimulative?
Mm-hmm. I certainly, if I were designing tax reform, I would certainly gear it towards lower income people. There's no question. In part to offset some of the inequality issues. Although I have to say this, and this is sort of one of those enduring myths, and I'm not suggesting you're buying into it, but U.S. tax code, U.S. tax law is actually fairly progressive. I mean, I'll do this because I do with every audience. What percent of total tax receipts do you think the top 5% pays? Now, I'm going to ask you to do it this way. 50. Okay? What percent, just think in your mind, what percent of total tax receipts does the top 5% pay? How many think it's 10%?
No, 50.
How many thinks it's 20%?
50%?
50?
It's 40.
Oh, that is-
So that to me is a progressive tax structure. So I don't think that's the problem, okay, I really don't. I think it's a couple of things, and I really laid them out. And in the structure, I do believe it's structural, because we've seen it going on. I mean, this has been going on 20, 30 years now. Technology is probably the most powerful force here. Because what's happening is it is eliminating a lot of jobs of low-skilled workers. And we, in the West, not just the US, but in the West, have failed to help those people. What I keep calling the left behinds, have failed to help those people. This has been going on. Globalization definitely has the same impact, and it's been blamed, I think, not wrongfully, but it's been given too much credit for what's going on. And then finally, this recession, which obviously hurt low-income, blue-collar workers more. I think that's much, to my way of thinking, a bigger factor than tax policy alone. I'm not saying tax policy doesn't have an impact, but it's just because I think our current structure is reasonably progressive. I don't view that as the major problem here. I think the major problem is we have not put in place policies to help those people who've lost out. You had a question,
Yeah. You say that more immigrants would benefit the United States, and clearly we have all these people that are streaming up here from Central America. I mean, how are you going to get the kind of immigrants that you want, the ones that are educated or whatever? I mean,
Yeah. To me, stop putting limits on H-1B visas. Why are we putting limits on H-1B visas? I mean, we've lowered the limits, by the way, recently. So I would say make the H-1B program more generous. I would say, I mean, when you think about it, a lot of, make it easier, more friendly for foreign students to come here. We've now made it very difficult for foreign students to come, and their numbers are dropping. A lot of people would like to get educated in the US, and once they're educated, they want to stay in the US. My feeling is let's make it as easy as possible for both of those, that they come to the US, it's the best and the brightest, and they stay here. Because history has shown us again and again, these people create companies, they create jobs. It's just nothing but really strong positives from that. But even the low-skilled immigrants help. Because what? They take the jobs that most people don't want in the US. So what is the problem with that? I don't see a problem here. They're not taking jobs away. So in that sense, I agree with you. We should favor skilled immigrants. No question in my mind. Totally agree with you. But not at the expense of a broader immigration. Now, there is this issue of, okay, illegal immigration, legal immigration, and so forth. But again, we have to look at that in perspective. How many illegal immigrants are there in the US? I've heard numbers like 11, 12 million. That's a fraction of the US population. Really is. So it's not a huge problem that we're facing. And these people all work hard. They give more than they take. They're not welfare, living off welfare. They're not, because they can't.
Because they're not citizens?
Right.
Yeah.
I mean, some of them may have fake social security cards, but a lot of them can't. So I just don't see the problem. So I see what the problem is. It's fear-mongering is what it is. Somehow or other blame people outside the US, countries outside the US, for our own problems. It's crazy. Yes, and I'll come around to it. We've got a little bit more time for questions.
So I have a question back to debt.
Yeah.
And I've seen debates in various publications and all that, how, all the things you talked about, debt, how, challenging it is if we have another recession, or all the payments we have to make on the debt as it grows. But if you look at countries like Japan, China, and if you look at their ratios, where their debts are, there is a school of people who believe that we overreact to debt.
Yeah.
And we only look at what the number is, like you said, trillion, but if you also look at how our economy has grown, population has grown and all that. So what's your view on from the other side of this whole debt debate?
That's a really good question. And I would say you picked two countries, maybe a third one I should throw in there. Japan, China, Italy. Who holds that debt? It's held domestically.
Well, I was going to say that, yeah.
That's a big difference.
Right, I'm aware
That's a
of that.
big, big difference.
That
If it's
has
held
pluses and
domestically-
minuses
yeah.
too.
Oh, of course it does.
Right.
But my point is, if it's held domestically, it's less of a crisis.
Correct.
It becomes less of a crisis.
Yeah.
It's still a drag on growth, and it will be for China, by the way, and it has been
Yes.
for Japan
Yes.
and Italy. All three are countries
Right.
that are struggling in terms of growth. But it's not a source of crisis, is the way I would say it. So that's the only distinction I'm drawing.
Okay.
But it's a worry. I'll try to come around to everybody. So we got a couple more here and one over there. Yes.
So why is there a reluctance not to generate a balanced budget? I mean, states require that. Why doesn't the federal government pursue that?
Have you seen Alexander Hamilton, the musical? There's the answers right in that musical. Okay. No, seriously. You know what the big. I mean, some of you know the story, but it was a big compromise that came about between Hamilton on the one hand and Madison and Jefferson on the other. In those days, there were a lot of states with massive debts, including Massachusetts, by the way. Massachusetts was a heavily indebted state, whereas states like Virginia were not, for a variety of reasons we can get into later. But Hamilton wanted to federalize the state debt, basically take it on, and in the process, he thought, and I think in the end he was right, it would help the U.S. economy do well. And so that was the sort of the Northeast, New York, Massachusetts kind of point of view, whereas Madison and Jefferson essentially said, why should we subsidize you guys? Why should we help you guys out? And the deal was, if you remember, is that they agreed on a compromise. And the compromise was that, yes, they would go ahead and do this sort of federalization of the debt, but the capital would have to move from New York to Northern Virginia. And it's actually part of the musical. If you haven't seen it, you have to see it. It's this fabulous, fabulous show that doesn't. I mean, have you seen it? Yeah, it's just incredible. But there's a real meaty part to it, which is this. So, yes.
Yeah, a question about future jobs. So I understand the point of view that every other technological revolution has ended up creating more jobs than are destroyed. It might or might not be the case this time, but the question is the kind of jobs. So if the jobs that are being created are all for highly skilled, highly educated people, there's going to be a larger portion of the population that can't take those jobs.
No, I think you put your finger on it. And let me give you a little bit of context, both on the sort of the fun side and the more serious side. The fun side is every one of these technological revolutions, there's been fear of job losses. So some of you are familiar with the term Luddite. It comes from this British guy called Ned Ludd, And what they did was they protested against machinery being brought in. And they broke machines, and there's a lot of commotion around that. But one of the placards that was shown during that era was, "You can't eat machines." This had to do with, you know, the farmers and so forth that got lots of them. So there's always fear. But the legitimate, I mean, you raise a lot of legitimate points, but I think the key point that I would focus on is that in the second industrial revolution, which is electricity and combustion engine and so forth, internal combustion engine, what we did in the US and in Europe was we improved educational attainment. We put a lot of resources into getting people to get high school degrees, going to college and so forth. And we need the equivalent of that, not quite that, but the equivalent of that. Now, more resources going into making sure people finish high school, making sure more people go, not necessarily into liberal arts colleges, but you know, vocational schools or technical colleges or whatever. I think we need a much bigger push in that direction. And it will take years to pay off. It's not something that's going to happen. But it worked. It really worked in the early 20th century when we did that. So I think, to me, that's a perfect example of what we did and what worked. And so we have to kind of go back.
That takes a lot of time.
It takes time. It takes money. And I think, but we have to start it now.
Right, the truck drivers are gonna be displaced
Yeah,
by
no, I
automatic
think,
trucks
and
in a few years.
I think that's the issue. That is the issue. There is dislocation. But if you look back, and just make this point one more time. If you look back in the last 3 industrial revolutions, there was no mass unemployment. You know, it wasn't the Marxian view of the world that somehow or other, you know, productivity improvements would mean, you know, millions and millions of workers on the streets. Didn't happen. Didn't happen. Yeah, back there. And I'll try to get to a few more before we have to end the
I didn't quite follow your explanation of the mechanisms of the back and forth of China and the excess capacity in the steel industry. So what are they doing
Okay.
with that
It's
excess capacity?
It's a good question. What are they doing with it? A lot of it is sitting idle. But let me back up a second. So what happened was that basically in 2008, 2009, the government essentially said to banks, go forth and lend. And it's not so much the federal government or the central government, but the provincial governments thought, aha, this is great, perfect opportunity. Every one of them wanted a steel mill, every one of them wanted an automotive plant or 2 or 3, every one of them wanted a chemical factory. So they all went out, all 31 provinces in China, and built this stuff. So what's happening is that a lot of them are sitting idle. I mean, that's the problem. They can't sell this stuff fast enough, and they can't lower prices enough. And so it's an issue. I mean, they've already actually hurt a lot of industries in the West, chemicals industries, steel industries. I mean, there are other issues with chemicals and steel that, Walter knows more about it than I do. U.S. steel industry is an interesting case in point. It's easy to blame the Chinese, but the reality is they've got a lot of excess capacity that's sitting there idle, basically, not being used, not producing any.
So doesn't that put a long-term cap on inflation going forward?
Absolutely, in terms of price inflation, it does. Not so much wage inflation, perhaps, but definitely price inflation in manufacturing. I'm just trying to be a little clearer. You're absolutely right. Yes, let me take that and then come back to you.
Well, maybe I'm missing what your implications are here, but I'm concerned about the role of government versus private industry in terms of increasing productivity and so forth. And that is, what's the role of government, for example, in trying to increase the education
Yeah.
system? My point of view is that government should put more into it, but by doing that, I mean, that's just one example. By doing this, you have to raise taxes, it seems to me. And it seems to me that's one of the big problems in our policy right now, is that people are always opposed to taxes.
Yeah.
Across the board, whether it's the ones who are making a lot of money or the ones that don't, so forth. What's your view about what we should do in terms of the taxes?
Yeah, no, I
In terms
think-
of trying to increase
Yeah.
the productivity of everyone.
Yeah, I'm very sympathetic to what you're saying, because there are a number of things that are sort of public goods that have a big influence, or potentially big influence, on productivity. Education, clearly one of them. Infrastructure, clearly another one. But there are also, I think, ways in which you can encourage through the tax code and in other ways, through R&D spending, you can encourage companies to invest more in new technologies. So I think it's a balance. So it's not all raise taxes and spend. I mean, the problem, and I think I'm how to say this? I think the private sector in the end, really has to play the lion's share of the role, but the governments can be sort of the handmaiden, if you will, of the economy, and that's not the best way to say it. But a catalyst maybe is a better word. But the catalyst through encouraging and spending on public goods, what we call public goods, because private sector is not going to invest in education that much, or really be sort of reluctant on infrastructure unless they get something from it. I mean, roads, I can't imagine the private sector is going to want to go after, invest in roads. But airports, maybe. There are other aspects of infrastructure that you might be able to get the private sector to jump on. So it's a balance. Are we taxed too little and therefore not spending enough? I'm sympathetic to that view. I don't think the U.S. is taxed particularly heavily. The worry about the government getting too involved in the economy has to do with wastage. And we know example after example after example that government waste can really kind of get in the way. So it's a balance. I'm not saying, I'm not on one side of the divide or on the other. I'm sort of in the middle. There is a role for government, no question. But there's a huge role as well for the private sector. And in the end, if you can't get the private sector to really sort of step up to the challenge, it's not going to work. It's just not going to work. And I think we've seen this in other countries where the government has tried to impose their will and tried to force companies to do this, that, and the other. And I think in the end it's backfired. I mean, some people, I'm not saying everybody in this room, but some people just sort of mesmerized by the Chinese, this sort of top-down approach to economic development. It works briefly, and then it bogs down. And it happened in the communist system. We worried that the communists were going to eat our lunch, the Soviet Union in particular, or the Japanese even. And those kinds of top-down models in the end grind down. They work for a while, and then they don't. In the end, just to paraphrase Churchill, capitalism is the worst system except when you start to consider the alternatives. So just maybe, I don't know, maybe three more. 1, 2, 3. We'll start with you.
Okay. You talked a little bit about Fed managing the economy. What does the growth of cryptocurrency have on their ability to control things?
Yeah, it's an interesting question. I have to be honest with you. I'm not sure I've totally figured out or decided what I think. I think you have to look back a little and look under the cover. The underlying technology, blockchain, I think is going to transform the way we do a lot of things. So I think that's, to me, is very promising. Cryptocurrency is a little harder to tell because it's been a bubble. Talk about bubbles. That's an area where there's a bubble. About a year ago, I was giving a similar speech and somebody asked me, should I invest in Bitcoin? I said, forget it. I said, if you got any money in there, get it out now. And sure enough, 2 weeks later, boom, it started to go down. So it's the problem is it's a combination of things. A little bit caught up in the mania. Now, I think you ask a serious question in the sense that could cryptocurrencies in some 5, 10, 20-year context become part of our monetary system? I think it's possible. We're nowhere near close to it yet. So I think we're still a ways away, but I think it's entirely possible. So, yeah. And then Walter, last one.
Okay, it's a question about the trade. So I agree with your comments, like, the right way to approach is to work with allies and put pressure on China, and the risk we see if we go with 25% more, economy could be down by 0.5 percentage point. And then there seems to be that there's no policy there, right?
Yeah.
So one thought I've seen this view also, that it's a much bigger problem because what America sees China becoming is another superpower. Through intellectual property theft and everything else, they have gone to a position where they're already a number 2 economy. So it's a bigger, longer term problem that we have to address. And I look back and I say, okay, the way Reagan tried to, took care of Soviet Union. So maybe is this the new approach to, and I had views on Trump, which are, I won't share here because somebody's going to kill me if I do that. So just your thoughts on what I
That's a
said.
good question. I think China is a formidable competitor,
Yeah.
but China is also, as I said earlier, not been playing by the rules. And they have to play by the rules. If they want to play in this space, they have to. And I would agree that up until Trump came along, very few people really were open about saying it. So again, I have my views on Trump. They're not always positive views. But on that score, I think the fact that he's highlighted it is a good thing. The way he's gone about it is a bad thing.
Yeah.
Okay?
I agree
So
with
I
that.
just said that. Yes, Walter.
Among the stimulative things that the Trump administration is said to have done is deregulation as well as tax cut. Could you comment on the extent and importance of deregulation as a economic stimulant, both short-term and maybe long-term?
What we hear from our customers is they're very happy about the new pro-business, business-friendly environment that they're facing now. They were very unhappy with Obama. Obama was really regulation happy, if you want to say it that way. The statistics we've heard was that in the waning year of the Obama administration, every day there were 2 new regulations. Now there's 0 new regulations. Now, how much has been cut back is a little hard to tell, but certainly that momentum in terms of regulations eased off quite a bit. And as I said, what we hear from our customers, who are very corporate focused, let's be honest, but is that they're much happier, regardless of all the other issues going on. Trade, I think they're very unhappy about. But on the regulatory front, they feel that this administration is very business friendly, and they're pleased that that things are changing or could change. But anyway, it has slowed way down. Okay. All right. Well, thank you all very much.